Hello, and welcome to The Pitch, brought to you by Livewire Markets. I'm Hans Lee, and in this series, we have been looking at the value of alternative investment strategies. First in a benign, low volatility environment, and then in a correction-prone environment, kind of like the one we went through in early August. For this last video in the series, we're going to be looking at the value of alternative investment strategies in a bull market. And here to help us with that is David Helms, Head of Diversified Alternatives at Janus Henderson. Good to see you, David.
Thanks, Hans. Good to be here.
So I guess you could argue that a lot of the post-COVID era in public assets was a fabulous time. Just buy risk and stay invested for the most part. So why should investors still have a portion of their portfolios in a multi-strategy fund like yours when 2008 to 2020 periods like that were the case?
Well, I guess the reason is that investors don't have perfect foresight, can't time perfectly. So if we knew that it was going to be a bull market and that assets were going to go up, then you don't need alternatives, you don't need hedging, just be fully invested or lever up and let the good times roll. But we don't know that, and it feels obvious in hindsight that it was going to happen, but there are no sure things in markets. So the proposition of alternatives, it's kind of in the name, is to be there when things don't necessarily work out the way you expect them to or the way you hope them to.
Yeah, and 2022 was a perfect example of that. So even in a bull market, David, I'm curious, how can you add alpha using the strategies you use? And can you do that without taking material extra risks?
I think it's key not to take material extra risks. So you don't want to be in a situation in a bull market where if you have the equity market up 15% or 20%, that you're trying to keep up with that. Because if you keep up with that, and you alluded to it in your question, you're going to have to take extra risk. That extra risk, that beta equity market exposure that you might load up on to stay in touch with the market is something that will come back and bite you if you're wrong and the market sells off. So it's not about doing as well as the best asset that's out there. It's a matter of sticking to your strategy and accepting that there will be times that your performance won't be as strong as other asset classes.
Yeah, no, absolutely. So of the various strategies that you use, and in your multi-strategy fund, I know that you have, I think, 6 or 7 different strategies that you can use. Which of those have the potential to add alpha, the most alpha, let's say?
So there are 7 strategies we run. There are 6 strategies that we call risk-on strategies. They're designed to work in up markets, so in bull markets, in flat markets, and in down markets. And there's a 7th strategy called protection. It's a top-down strategy that typically pays premium away. So it's an insurance strategy of a sort. And that one tends not to make money in bull markets, but all of the other 6 we would expect over the long run. Not all of them, not all the time, but those 6 in aggregate should make strong positive alpha when the market is up.
Okay, so maybe if I could press you there, could you give us an example of maybe one of the strategies that you use in the fund and how that adds alpha, or what you do to that particular strategy to add as much alpha as you can for as little risk as possible?
Convertible arbitrage is something that is interesting because there's a big funding advantage for convertibles right now. If you're the CFO of a publicly listed company, it's much more advantageous to raise money in the convertible market than in the high yield market. But in order to get convertible investors into the issue as you raise money, you need to price the convertible slightly cheap. And that's the arbitrage edge that we look for, is slightly cheap paper. So an environment that causes companies to want to issue lots of convertibles creates lots of opportunities for us. And we're in exactly that environment at the moment. There's a big need for refinancing, and there's a big advantage to convertibles in this environment.
Okay, so just to clarify there for our audience, convertibles, you're talking about convertible bonds specifically,
Correct,
right?
yeah, that's right.
And I guess, how are you making your profit on that? Is it based on yield? Is it based on spread? I'm just trying to get a sense of how profit comes through in that particular asset class.
The way we look at it is convertible arbitrage, and arbitrage is always about comparing a security to the pricing of another security. And classically in convertibles, it's the convertible bond, which gives you equity upside, but fixed income performance on the downside, that we compare with the valuation of an equity. And the way we express that in the portfolio, long the convertible bond and short the equity, and that spread between them is what we're trying to capture as the arbitrage position.
Yep, understood. Okay. So just finally there, David, I mean, I was interested reading in your fund documentation, one of the things you try to do, you try to find new sources of return and avoid crowded trades where you can. So I'm curious if we could finish on this. All bull markets have, actually all markets have crowded trades, I guess, of some form, right? But particularly in bull markets. Maybe what is one crowded trade you're seeing in markets at the moment? And what is one strategy you're finding the most upside opportunities in right now?
So one crowded trade is the market for volatility, particularly equity index volatility. So we find that when markets are benign, people like to sell put options, and it kind of makes sense. You don't expect the market to have downside, make somebody else pay you a premium for downside you don't expect to occur. And this has become somewhat of a crowded trade, lots and lots of people selling volatility, and this compresses the price of volatility, and what it means that if you take the other side of that crowded trade, so we don't like to be the same side as the crowding, we like to be the other side, because if the assumption that the crowded trade is premised on changes, then there's opportunities to make outside profits. And we have seen a big spike in volatility, and a lot of that is to do with the crowding starting to unwind in that particular trade.
Right, nicely explained. Thank you very much there. That's David Elms of Janus Henderson. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more episodes of The Pitch. We hope you've enjoyed the series, and we'll see you again soon.